Listen up, because we're talking about building serious wealth. We're diving into a high-risk, high-reward investment strategy aimed at reaching a cool million. Right now, our portfolio sits at $100,000, a solid chunk of cash ready to be put to work. This isn't about throwing money at the market blindly. This is about strategic investments and smart use of leverage. We're not just aiming for average returns, we're playing to win big. But remember, big rewards come with big risks. This isn't for the faint of heart. This is for those ready to take control of their financial future and build something substantial. We're in it for the long haul, ready to weather the storms and come out on top. Let's get started. We're not just sitting on our initial investment, we're adding fuel to the fire every single month. Our plan? $2,000 of your hard-earned cash invested directly into the market. But here's where things get interesting. We're leveraging our investments, borrowing an additional $3,000 each month to supercharge our growth. That's right, we're playing with fire, but we're doing it strategically. This borrowed money, this leverage, is a double-edged sword. It amplifies our gains when the market is up, but it also magnifies our losses when the market takes a dip. This strategy isn't for everyone. It requires a strong stomach, a long-term perspective, and a deep understanding of the risks involved. Are you ready to play the leverage game? Let's talk about debt, the elephant in the room. We're borrowing $3,000 every month, and that debt comes with a price interest. We're assuming an interest rate of 5% per year, which adds up over time. As our debt grows, so do our monthly interest payments. This is a critical factor to consider, as it eats into our potential profits. We need to make sure our investment returns outpace our interest payments. This is where things get tricky. We're walking a tightrope between maximizing leverage and managing our debt. It's a delicate balance, and it requires constant monitoring and adjustment. Remember, debt isn't inherently bad. It's a tool, and like any tool, it can be used wisely or recklessly. We're using debt strategically, but we're also acutely aware of the risks involved. Now for the exciting part, projecting our portfolio growth. We're assuming an average annual market return of 8%, a reasonable expectation for a well-diversified portfolio. With our monthly investments, leverage, and projected market returns, our portfolio is expected to balloon to over $1 million in 15 years. That's the power of compounding and strategic leverage at work. But remember, these are just projections. The market is unpredictable, and our actual returns may be higher or lower than expected. We need to be prepared for all scenarios, both good and bad. This is why we diversify our investments, spreading our risk across different asset classes and sectors. We're not putting all our eggs in one basket. We're building a resilient portfolio designed to weather market storms. Section 5. ETF Blueprint. Allocation Strategy for Maximum Returns. We're not picking individual stocks here. We're keeping it simple and effective with exchange-traded funds or ETFs. These bad boys allow us to invest in a basket of assets with a single trade, providing instant diversification. Our ETF allocation strategy is designed for growth. We're overweighting sectors poised for future growth like technology, healthcare, and renewable energy. We're also allocating a portion of our portfolio to more established sectors like financials and consumer staples for stability. This allocation strategy isn't set in stone. We'll rebalance our portfolio regularly, adjusting our allocations based on market conditions and our risk tolerance. Remember, diversification is key. By spreading our investments across different sectors and asset classes, we're mitigating risk and positioning ourselves for long-term growth. Section 6. Risk Radar. Navigating market volatility and interest rates. Let's be real, there's no such thing as a risk-free investment, especially with a leveraged strategy like ours. Market volatility and fluctuating interest rates are our constant companions on this journey. Market volatility can make or break our portfolio. Sudden drops in the market can amplify our losses due to leverage. That's why we're mentally prepared for the roller coaster ride and avoid panic selling during downturns. Interest rates are another wild card. If interest rates rise, our borrowing costs increase, eating into our profits. We need to factor in potential interest rate hikes and adjust our strategy accordingly. Managing risk is all about understanding the potential downsides and having a plan to mitigate them. We're not just hoping for the best, we're preparing for the worst. Section 7. Storm clouds preparing for market crashes and rising rates. We can't predict the future, but we can prepare for it. Preparation is key to navigating uncertain times. Market crashes and rising interest rates are not a matter of if, but when. These events are inevitable in the financial world. We need to be ready. Having a solid plan in place can make all the difference. A market crash can wipe out a significant portion of our portfolio, especially with leverage. It's crucial to understand the risks involved. Our plan? We ride out the storm. We don't panic sell. Staying calm and focused is essential. We view downturns as buying opportunities, a chance to scoop up assets at discounted prices. This strategy can pay off in the long run. Rising interest rates can cripple our strategy by increasing our borrowing costs. It's a challenge we must address proactively. To mitigate this risk, we explore fixed-rate loans and consider deleveraging if rates become unsustainable. Flexibility is key. Remember, risk management is not about avoiding risk altogether. It's about understanding, mitigating, and preparing for potential downsides. It's about being smart and strategic. We're not afraid of the storm. We're battening down the hatches and weathering it. With the right preparation, we can face any financial storm head-on. Section 8. Safety Net, Risk Management for Sustainable Growth. We're playing a high-risk game, but we're not playing recklessly. Our approach is calculated and strategic, ensuring that every move we make is backed by thorough analysis and foresight. We're implementing a safety net to protect our investments and ensure the sustainability of our strategy. This safety net acts as a buffer, shielding us from unexpected market fluctuations and economic downturns. First, we're maintaining a cash reserve, a financial cushion to cover potential losses and avoid forced selling during downturns. This reserve is crucial for maintaining liquidity and operational stability. This cash reserve provides peace of mind and flexibility. It allows us to navigate through tough times without compromising our long-term goals. Second, we're diversifying our investments across different asset classes, sectors, and geographies. Diversification is a key strategy to spread risk and enhance potential returns. This diversification mitigates risk by ensuring that a downturn in one area doesn't sink our entire portfolio. It provides a balanced approach to growth and stability. Finally, we're continuously monitoring our portfolio, adjusting our strategy as needed based on market conditions, interest rates, and our risk tolerance. This proactive approach helps us stay ahead of potential risks. We're not passive investors. We're actively managing our portfolio for long-term success. Active management allows us to capitalize on opportunities and mitigate risks in real time. Remember, risk management is not a one-time event. It's an ongoing process. It requires constant vigilance and adaptability to changing market dynamics. We're constantly evaluating, adjusting, and fine-tuning our strategy to navigate the ever-changing market landscape. This continuous improvement mindset is what sets us apart and drives our sustainable growth. Section 9. The Final Word. Balancing risk and reward on your journey to $1 million. We've laid out a comprehensive roadmap for building $1 million portfolio, but it's important to remember that this is not a guaranteed path. Success in the financial world requires more than just a plan. It demands adaptability and resilience. This high-risk, high-reward strategy requires discipline, a long-term perspective, and a willingness to embrace volatility. It's about staying the course even when the market gets turbulent. Remember, leverage is a double-edged sword. It can be a powerful tool, but it must be used wisely. It can amplify gains, but it can also magnify losses. Understanding this balance is crucial for any investor. We're using leverage strategically, but we're also acutely aware of the risks involved. Risk management is paramount. This means constantly assessing and reassessing our strategies. We're diversifying our investments, maintaining a cash reserve, and continuously monitoring our portfolio to mitigate potential downsides. Diversification helps spread risk across different assets. This journey won't be easy. It will test your resolve and your patience. There will be ups and downs, market swings, and moments of doubt. These are inevitable parts of the investment journey. But with a sound strategy, a disciplined approach, and a long-term perspective, we can navigate the challenges and come out on top. It's about staying focused on your goals. Are you ready to take control of your financial future and embark on the exciting journey to building $1 million portfolio? The choice is yours. Embrace the challenge and start today.